It's the world's most trusted institution. It has marble lobbies and serious logos and people in suits behind glass. It holds the money you were paid this morning, the savings you've been building for a decade, the funds earmarked for your child's college. So when it fails, it doesn't feel like a financial event. It feels like the ground itself has decided to stop being solid. Banks fail. They have always failed. And understanding exactly what happens when they do is something every person with a bank account genuinely needs to know. Picture this. It's the year 2023. Silicon Valley Bank, the 16th largest bank in the United States, collapses in 48 hours. Customers wake up on a Thursday to headlines they can't quite process. By Friday afternoon, regulators have seized the institution. By the following Monday, the story has rewritten itself 3 times. The panic came faster than anyone planned for. But the panic wasn't the beginning. It was never the beginning. Before a bank fails visibly, it fails quietly. Long before the headlines, regulators have usually been watching. Balance sheets deteriorate. Loan portfolios sour. Interest rate exposure builds up like pressure behind a wall. The theatrical version of a bank collapse is chaos erupting from nowhere. The actual version involves spreadsheets, phone calls, regulatory warnings, and desperate private conversations, all before a single depositor knows anything is wrong. The drama the public sees is almost always the final act of a play that started months earlier, in rooms no one was watching. But then comes the panic machine. Here is the dark comedy at the center of every bank run in history. When people believe a bank is failing, withdrawing their money immediately feels like the rational move. It feels like the smart move. And it is. Individually. The problem is that everyone making the individually smart move simultaneously is precisely what transforms a wounded bank into a dead one. The bank was struggling on Tuesday. By Thursday, because 10,000 people all had the same logical thought at the exact same moment, it genuinely cannot survive. The crowd didn't predict the collapse. The crowd completed it. In 1930, a bank run meant physical lines around the block. Men in hats and overcoats. Newspapers passed hand to hand. The information moved at the speed of conversation. In the modern era, it's a tweet, a Reddit thread, a screenshot of a withdrawal limit shared in a group chat at 2 in the morning. The speed of panic has multiplied by an order of magnitude. The underlying human psychology hasn't changed by a single degree. Social media didn't invent financial fear. It just gave fear a same-day delivery option. Before going further, there's something essential to understand about what a bank actually does with money. Deposits come in. Loans go out. The bank earns the spread between what it pays depositors and what it charges borrowers. At any given moment, the cash sitting in the vault covers only a fraction of what is owed to depositors. This isn't a scandal or a secret. It's literally how every bank on earth has always operated. Fractional reserve banking. The math works beautifully in normal times. But when everyone wants their fraction simultaneously, the math stops working entirely. A bank run isn't a mob storming a castle for no reason. It's a systems failure triggered by a design feature that nobody mentions on the welcome pamphlet. And then, the government shows up. By the time a bank failure makes the news, the FDIC has usually been watching the situation for weeks. The FDIC doesn't react to headlines. It monitors institutions continuously. It tracks capital ratios, reviews loan quality, and identifies stress long before the public has any idea something is wrong. Regulators move early, and they move quietly. They try private rescues first. They look for buyers. They have conversations in rooms with no windows and no press releases. The panic outside is often the last resort, not the first signal. The resolution weekend is genuinely dramatic, and it deserves to be told that way. Regulators move in, almost always on a Friday afternoon when markets are closed. They take control of the building, the systems, the books. They work through 48 hours to map everything the bank owns and everything it owes, and to arrange what comes next. By Monday morning, when markets open, there's a plan. Just imagine the logistical reality of that. An entire financial institution with thousands of accounts, billions in assets, dozens of loan portfolios, essentially acquired and reorganized, while most of the country is watching college football. That is what a resolution weekend actually is. The outcome lands in one of two directions. In the better case, a healthier bank steps in and agrees to absorb the failing one. Customers wake up Monday morning with a different logo on their banking app and barely notice a thing. Their money is there. Their direct deposits still work. Their debit cards function. In the harder case, the FDIC takes over directly. They begin winding down the institution's assets piece by piece, selling loan portfolios, liquidating holdings, returning insured funds to depositors. Neither outcome is glamorous, but both are far more orderly than the panic implied they would be. The story behind why any of this works the way it does begins in the 1930s. The Great Depression didn't merely damage the American banking system. It destroyed it. Thousands of banks failed. Ordinary people lost their savings completely and permanently. A family that had spent 30 years building a deposit account watched it disappear simply because their bank had lent the money to people who couldn't repay it. There was no rescue. There was no floor. The panic was rational because there was nothing to stop it from being rational. Policymakers looked at that catastrophe and asked a very specific question. What breaks the cycle? The answer was deposit insurance. If depositors knew their money was guaranteed by the government up to a certain limit, they'd have no reason to panic, no reason to run. The rational move and the calm move become the same move. The FDIC was created in 1933, and it has paid out successfully through more than 3,000 bank failures since then. The coverage works like this: $250,000 per depositor, per institution, per account category. That number matters enormously when you get specific. A person with a checking account containing $40,000 loses nothing if their bank fails. Their money is protected, full stop. A business with $3 million sitting in a single account at a single institution? They have a genuine and serious problem. But a wealthy individual who spread savings across multiple banks, in multiple account types, on the advice of a financial advisor, was probably fine all along. The quiet irony is consistent across every bank failure in history. The people most visibly panicked are usually the people with the least to worry about. And the people with the most to worry about often didn't realize they should have been worried until it was too late. The fund behind the promise is real, but finite. Banks pay premiums into the FDIC insurance fund the same way drivers pay into an auto insurance pool. The fund backs deposits, covers losses, and in extreme scenarios, Treasury mechanisms provide additional backing. It isn't unlimited. It isn't magic. But it's also not a bluff. It has worked consistently across 9 decades and thousands of failures. The failure itself, though, doesn't stay contained. When banks fail, or even when they simply become frightened of failing, they lend less. When they lend less, businesses borrow less. When businesses borrow less, they hire less, invest less, expand less. A regional bank collapse that directly touches 30,000 depositors might affect 200,000 people indirectly through its effect on small business credit across an entire region. That is the invisible damage, not the headline, not the dramatic Friday afternoon seizure, not the Monday morning logo swap. It's the credit contraction that spreads outward for months afterward, quietly. The economic cold that follows the financial fever. Underneath all of it is the thing that actually holds banking together. Not gold, not deposits, not physical assets. Confidence. The entire financial system is a confidence machine. Banks lend because they're confident in borrowers. Depositors deposit because they're confident their money will be there. Investors invest because they're confident in the stability of the system itself. When a bank fails visibly and badly, it damages confidence in similar banks, in neighboring institutions, and in the broader framework. This is why regulators treat even small bank failures with serious theatrical force. They aren't just closing a balance sheet. They are managing a story that millions of people are watching and interpreting simultaneously. Perception is the product. The question of contagion, whether one failure becomes many, depends entirely on what the failing bank actually had in common with its neighbors. Banks holding similar assets, facing similar interest rate exposures, or operating with similar structural weaknesses are legitimately vulnerable to the same forces that brought down the first one. Banks that are superficially similar but structurally different are usually fine, even if the market can't always tell the difference in real time. The panic narrative feeds on surface association. Regulators and analysts try to cut through to the underlying balance sheet reality. But markets? Markets often take a few days to catch up. What follows a significant banking crisis is predictable. Regulatory reform, new capital requirements, liquidity tests. Stress tests designed to identify the next vulnerability before it becomes the next headline. Banking crises are expensive. They are painful. They are also historically reliable generators of reform that make the system more resilient than it was before. Until memory fades, until the reforms feel like bureaucratic overhead rather than hard-won protection, until the cycle begins again. So, here is what you actually need to know. Check whether your deposits are FDIC insured. Know your coverage limits if your balances are significant. Understand that spreading money across multiple institutions and multiple account categories is not paranoia. It is straightforward risk management. And appreciate that the stomach drop feeling you get when you see a bank failure headline is human and real, and almost certainly unnecessary if your situation falls inside the protected range. Bank failures are not evidence that the financial system is broken. They are the financial system working. Slowly and painfully, and sometimes dramatically, but working. Bad banks make bad decisions and fail. Healthy banks absorb them, or the government manages their exit. Insured deposits are protected. Credit tightens, and then gradually loosens again. The economy bruises and then heals. The story the headlines tell is apocalyptic. The story that actually unfolds is cyclical. Understanding the cycle is the single most powerful protection against being controlled by fear of it.